Hello and welcome to my presentation of my financial analysis on evaluation of Adidas, Google and Hornbeck. I did a little presentation analysis on those three companies to figure out which of those I would give a 1 million 6-month loan to, which of those three I would give a 5-year $1 million loan to, and of which company I would buy 50% equity if I had a chance. So looking at my little outline here, I'm starting with the $1 million 6-month loan, and I'm going to go through the liquidity ratios and explain them a little bit, and I'm going to analyze each of them and compare the companies coming to a conclusion. For the 5-year loan, for the long-term loan, I'm going to look at the long-term solvency ratios. I'm going to explain them a little and then compare the companies again and figure out which one would be the trustworthy one for talking about a long-term credit. My last point will be about my 50% equity investment, and I'm going to look at the return on equity comparison, but I'm also looking at the DuPont analysis to see which ROE is really the best one of each company, and I'm going to look at each single price-earnings ratio and figure out which company would be the best for me to buy right now. So let's start with the $1 million 6-month loan. The liquidities ratios I use are the current ratio, which is calculated by current assets over current liabilities. So what I'm basically trying to figure out with this ratio is if a company would be able to use their current assets to pay back their current liabilities, and I can basically find an answer to if they will be able to pay me back within a year. For the quick ratio, which will be quite important too, since I picked Adidas as a company, and they are a retailer, and they are pretty immensely depending on the inventory turnover. So the quick ratio takes that into account and takes off the inventory from the current assets. And then the cash ratio, which is probably the most important one for a short-term loan, because I want the company to have enough cash, because I'm not sure if all their assets will turn over in those 6 months. So I will use the cash ratio to figure out which company is really able to pay me back. When I look at the current ratios and I look at the analysis, I see on the very bottom, I see Adidas, which was quite expected because they are a retailer system. Their current ratio is about 1.5, which means they still have about 1.5 times as much assets as they have current liabilities. So they will probably be able to pay me back. Looking at Hornbeck, which is the gray line, I can see they have a pretty high current ratio, but they also had a lot of volatility going on, and especially in the fiscal year of 2012. And looking on Google, the green line, I can see that their current ratio has been between 4 and 6, and has been most recently at about just below 5, which is a pretty decent current ratio, and they also had the least volatility in their current ratio. Looking at the quick ratio, which means taking the inventory out of this analysis, I see how Adidas drops below 1. So basically saying, taking out the inventory out of the current assets of Adidas, they won't be able to pay me back anymore because they won't have as much current assets as current liabilities. That's expected because Adidas depends, they're a retailer, they have to turn over the inventory to make their revenue, and if they're not able to, they will be in big trouble. And I mean, Adidas is a big company and they really know what they're doing, so they probably would not have a problem with that. But since I have the privilege to pick one, I would rather look at Hornbeck or Google. And just as the current ratios, those go kind of similar, and we see how Google had about on average as high quick ratio as Hornbeck did, but they had less volatility, so I'm still favoring Google for my short-term loan. Looking at the cash ratio, and as I said, it's going to be the most important ratio to look at for my short-term loan. If I was a bank, I was about to give a 6-month loan, I want the company to pay me back in cash. I'm not sure if the assets are turning over, so Adidas dropped even a little farther down, taking out the rest of the assets and just looking at their cash, while Hornbeck and Google are holding a lot of cash on hand. So they both have Hornbeck has about a cash ratio of 2, which means they have twice as much cash as they have current liabilities, while Google has almost 4 times as much cash on hand as they have current liabilities. So both of them would be pretty easy on hand to pay me back. But with my privilege of picking only one, I would be comfortable with both, but I would pick for my short-term loan Google to give a $1 million 6-month loan to because I'm most confident they will be able to pay me back. For the $1 million 5-year loan, which is a long-term loan, so I have to look at the company's long-term solvency ratios, which are, I picked the total debt ratio to do this, which is deprived of total assets minus total equity, which basically means all their debt, all their total liabilities over their total assets. So that basically means for each dollar in assets they have, how much liabilities do they have. So I want this ratio to be really low because a high ratio would mean they have more liabilities and they're using more liabilities to finance their assets. So they're probably going to have a lot of debt already and I don't want to give them any more money. The debt equity ratio sets into a relationship between how much debt they're taking and how much equity they're using to buy their assets. So for me, looking as a bank, giving a long-term loan, I want their debt to be really low, which means I want their equity to be high, which will mean a lower debt equity ratio for me would be better to loan a long-term loan to a company. The most important ratio here will be my times interest earned ratio, which deprives of EBIT over interest. So it means coming from the income statement, their earnings before interest taxes divided by the interest they have to pay. So how much money more do they earn that they have to pay in interest. So I want this ratio to be at least 1. So I'm making sure they earn at least as much to pay back their creditors. So the higher the times interest earned ratio, the more confident I will be they will be able to pay me back. Starting with the total debt ratio, I see right up here it's about 40%, which is Hornbeck. This is pretty high, and it shows me that Hornbeck is using a lot of credit to buy their assets and to finance their company, and they don't have much stock in there. Not as Adidas, they have pretty decent total debt ratio. It's about between 10 and 50%, and most recently it has been at 15%. And it shows me that they're taking not as much risk with long-term debt to finance their assets, but having a lot of stockholders' equity in there as well. The best one again would be Google though, because Google's is really low and it has actually a tendency to be still falling as of the fiscal year of 2014, where it was below 5%, which means Google is basically financing all of their assets with almost like zero debt. They're having a lot of stockholders' equity in there, which makes me as a bank really comfortable because I know they have a lot of stock in their game, they have a lot of own interest in their game, and they're not really depending on my credit because they don't have much of it already. Looking at the debt equity ratio and how it relates, Hornbeck, pretty high up there. It's about, well, it has been from between 90 and 70%, and most recently at 80%, which means they have way more debt than they use equity to finance their activities, while Adidas, on the other hand, has been quite low here, and they've been about 35 to 25%, and most recently just above 30%, which means they're using a decent amount of debt to pay their assets, but they're not only relying on it, and they're having a lot of equity in there as well. When I look at Google though, they're below 10%. They've been actually, once again, have been decreasing, which just makes sense because we just looked at the total debt ratio as well, and it had been decreasing. And they have been about 5%, so they're having so much equity in there, and their proportion of equity that they have in financing their activities is much higher than their debt, which makes me really confident actually to give them a loan because I know they're not taking much credit already. So if they would come to me and actually would ask for a loan, I would have no problem giving it to them. So looking at the most important ratio to figure out how well able the companies are going to be to pay me back on my long-term loan, I look at the times interest earned ratio, and I compare them to the companies, and well, we gotta watch the scale here a little bit because Google was really like through the sky, and they have been about 200 to 150 times as much earning as they had to pay back in debt. Well, this results from making a lot of revenue first of all, but also obviously not taking much debt, so not having much interest. And while they earned so much, they were easily about like 200 times as much. They were really able to pay back their interest. We look at Hornbeck has been the lowest, but Adidas has been quite down there too, which would be, I guess, like a normal ratio, but both of them would be above 1. So all of them would have the ability to pay back on their long-term liabilities because they're earning more than they have to pay in interest. But since Google has such an easy time to really pay me back, it would be Google also that I would give my 5-year, $1 million loan to. As for the 50% equity investment, and I would actually have enough money to buy one of those companies, or at least 50% in it. I looked at the return on equity, which is probably the single most important ratio whenever I analyze a company, which is derived of the net income over the total equity. So basically for how much money I have as an equity, how much money do I get back by the net income the company makes. And I'm also going to use with that the return on equity DuPont analysis, which means I'm going to split up return on equity not only in net income over total equity, but also into profit margin times asset turnover ratio times equity multiplier, which gives me the return on equity as well. Profit margin times asset turnover ratio is also called the total asset turnover, which is basically really important, but I like to split it down in all three parts of it, because the profit margin would really show me how well is the company doing, how much money are they making on each sale, basically how profitable are they. The asset turnover ratio is a measurement for their asset, their asset efficiency. How well do they use the assets, how often do they turn them over, how well are they, or do they just sit there and depreciate? While the equity multiplier will work kind of in the other direction, because it will show me how much financial leverage is the company already taking. More leverage, more money from creditors will mean I have more to invest, which will increase my return on equity. But the bad thing about this is that it will also increase the risk in the company, which means maybe the ROE will be higher, but also the risk I'm taking in that company will be much higher. So looking at the return on equity as I got it from Bloomberg, starting with Hornbeck, which had the lowest ROE overall, they had really trouble in like 2011, 2012, and they've been kind of going up since then, coming back up to 10% return on my equity, but still falling, while Adidas is a little higher there. It's right in between Hornbeck and Google, and it's been between 10 and 50%. They actually had trouble in 2013, 2014 as well, going back down below 10%, but it's still a decent return for Adidas. And for Google, they had the highest return on equity, starting at over 20%. And in 2010, over the last 5 years, they've been declining constantly, but I can see that well in this year, and in this year here most recently, apart from Adidas and Hornbeck, they all had declining paths, which makes me conclude that maybe there was something going on in the economy, and it's not really the company's fault since they all had a decline, but Google still has the highest ROE. So as of right now, I would actually favor Google because they give me the highest return on my equity. Looking at the DuPont analysis, splitting up on my profit margin of each company, the asset turnover, the equity multiplier, I'm taking profit margin times asset turnover, which will give me my return on assets, and then multiplying the return on assets times the equity multiplier, so the financial leverage, which gives me the ROE. So let's look at profit margins. Adidas is about 3, so they're obviously having the lowest profit margin of all 3 companies, while Hornbeck, a full service company, has about 14, and Google is almost at 22, which means Google is really, really profitable. With all they do, they're making a really high profit, which is really good, and I really, really like it. For the asset turnover, for this time starting with Hornbeck, they're a full service company, which means they don't have much assets. They don't sell anything, they only sell their services, which means they don't have as much inventory. So they're probably not going to turn as much over as a company like Google, which is a holding company. They have some kind of inventory, but they're still below 1, so it's pretty low. It's about 0.5, but that was expected for Google as well. Seeing Adidas, whose asset turnover is quite high, which means they're turning it over a lot. But they're a retailing company. They have to turn over their inventory. They're making sales. They're selling this stuff to the people. This is where they make their revenue. So as expected, their asset turnover should be the highest. So multiplying those two and seeing the relationship between them, still Google comes out to be the highest returning on assets, which means even though they're not turning the assets over as well, they're making enough profit out of what they turn over to be really, really profitable. Adidas is right in the middle of the 4, which is decent but far away from Google, and Hornbeck with 3 is still making some progress, but it's just out of the game talking about I only have choice to buy one company. Taking the equity multipliers, I see that Adidas and Hornbeck has the same equity multiplier, about 2.16, which means they're not taking much risk, but they're taking some risk, and which pumps up their return on equity to about 9 and about 6.5 for Hornbeck. And looking at Google though, since they have already been so profitable and their profit margin is just right through the ceiling, their equity multiplier is really high, as we already saw before. So they're not taking much risk in talking about getting money from creditors. So even though they're not taking much risk, they're still making the highest return on equity, which really sets Google in favor of me for buying a company. Looking at the price to earnings ratios, which derives from price per share over earnings per share, I want it to be really high, because I want the price of my stock in the company to be really high according to what I earn by being in the company. Looking in Hornbeck, which had a really strong decline actually, they've been going down through 2012, 2013. So I might have to guess that they had been kind of overrated, and people have figured that, and people just started to sell them because they just thought, well, Hornbeck, it's going down, but we're actually selling, or we're way higher than we should be. And they had a hard decline in this, so their price to earnings ratio went strongly down. While Adidas and Google have both been pretty stable, a little rising from where they came 5 years ago, but still, like, they had like a little fight right in the middle of 2012, where actually Adidas had a higher price per earnings ratio than Google, but Google came back up, and they have both been declining in the most recent year, but they're still pretty high up there. But still, Google is way higher, with about 25 to 30 price to earnings ratio. So I would really pick Google as the company I would buy, because they don't only have the highest return on equity, but they also by the market holders, by the customers, they're rated the highest. So coming to a conclusion and just wrapping it up again, I would give my short-term loan to Google because they have been the most liquid. I would give my long-term loan to Google as well, because they're not taking much credit yet, and I have absolutely no doubt that they will be able to pay me back very well and very easily. And I would also put a 50% equity investment if I had a chance into Google, because they had the highest ROE, they have the highest price per earnings ratio. But if I had the chance to buy another one, I might think about Adidas as well, because they've been doing well. But the only one I would really take out if I had to choose between those three companies would be Hornbeck, because they are undoubtedly doing, well, the worst out of those three companies. So thank you so much for listening to my presentation, and this is the end of it.